Hi guys. Today we will analyze Honeywell International stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. However, recent evolutions are not positive. The short-term trend is negative, the long-term trend is negative. There should be more interesting stocks out there. Strong support levels are around $172 and $162. Next strong support levels are around $150, $138 and $124. Strong resistance levels are around $182 and $196. Next strong resistance levels are around $214 and $232. In the last month the stock has been trading between $169 and $198 range, which is wide. It is currently trading near the lows of this range. The stock has an average volume of 2.9 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since August 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around -2% per year, for last 5 years. We see that the average profit margin of the stock has been around 13% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 141% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Honeywell Company: bad, average, and good. First scenario. Honeywell will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 2%. Future profit margin would be low, 15%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $88. Second scenario. Honeywell will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 3%. Future profit margin would be average, 15.5%. Future free cash flow to net income rate would be average, 85%. In this case, the fair value of the stock today would be $99. Third scenario. Honeywell will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 4%. Future profit margin would be high, 16%. Future free cash flow to net income rate would be high, 90%. In this case, the fair value of the stock today would be $112. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 7.53. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Honeywell, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 20. Again, I will use 3 different scenarios for Honeywell Company: bad, average, and good. First scenario. Honeywell will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future P/E would be low, 15. In this case, the fair value of the stock today would be $57. Second scenario. Honeywell will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3%. Future PE would be average, 17. In this case, the fair value of the stock today would be $71. Third scenario. Honeywell will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 4%. Future PE would be high, 19. In this case, the fair value of the stock today would be $86. As you can see, today the stock is overvalued, $173, even if we expect the company's high performance in future. The company has a good profitability and financial health. However, the stock is expected to show a very small growth in revenue in the next 5 years, 4 to 6% yearly. Based on that, the stock looks overpriced at the moment. The stock has been in a downward trend since August 2021, and it can go lower, before it recovers. I may consider buying the stock for the dividend, when the stock drops to $100. Company's strengths. Honeywell International is an American multinational conglomerate corporation. It operates in 4 areas of business: aerospace, building technologies, performance materials and technologies, and safety and productivity solutions. Honeywell is a leading blue-chip industrial company, with a long history of navigating challenging operating environments. Honeywell's aerospace products are used on virtually every aircraft, and its personal protection equipment has been in huge demand due to COVID-19. The aerospace segment will benefit from continued recovery in global airfare. Honeywell has a vast product portfolio, for both traditional and renewable energy sources. It has a recession-proof business model compared to many emerging small caps and startups in the crowded wind, solar, energy software platforms and battery energy storage niches. Honeywell is making several organic bets in mission-critical end markets, that should yield triple-digit internal rate of returns over the long term, including in quantum computing and building automation. The company has a strong balance sheet with $11 billion of cash on hand, and a commitment to investing in growth, and returning excess cash to shareholders. The company's return on assets of 8%, return on equity of 29% and profit margin of 15% are amongst the best returns in the industry. Risks. Key risks facing Honeywell are cyclical demand and capital-intensive operations. 85% of revenue is generated from cyclical end markets, including commercial aviation, commercial buildings, oil and gas, refining and manufacturing, which can suffer severe downturns during recessions. Honeywell's largest segment, aerospace, 45% of earnings, has particularly high risk due to unprecedented aviation industry distress during the COVID-19 pandemic. Honeywell is also subject to environmental risks, such as asbestos claims associated with a number of legacy businesses. The company has a growth by acquisition strategy, and is subject to integration risk with acquired companies. Honeywell generates substantial revenue overseas, and its results are typically linked to global economic trends. The company is also sensitive to trends in the dollar. Based on estimates for the next 5 years, the company will show a very small growth in revenue. The revenue will grow only by 4 to 6% on average per year. The earnings per share is expected to grow by 10% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.